This is Blackrock on the monthly chart. And two levels of interest include this resistance support band at the $600 level and this resistance band at $760. So those are the two major levels of interest in which price is currently in between, closer to the lower band, however. This is the weekly chart, and you can see sideways price action. However, the current momentum is to the downside as price is making lower lows and lower highs. When you go to the daily chart, you can see that price is below all the moving averages, and this cluster of moving averages is serving as dynamic resistance. Now, this past week, BlackRock reported earnings. And so if you don't know anything about BlackRock, they are an asset management behemoth, the largest in the world, with 424 ETFs totaling $2.3 billion in assets under management. And on Friday, they reported third quarter earnings that beat analyst estimates and said it had about $98 billion in inflows to its ETFs so far this year. Larry Fink, who's the CEO and one of the most powerfulest guys on Wall Street, stated the following: "For the first time in nearly 2 decades, clients are earning a real return in cash and can wait for more policy and market certainty before risking." This dynamic weighed on industry and BlackRock's third quarter inflows. So the company posted operating earnings of $10.91 for the third quarter, blasting past the $8.34 per share expected by Wall Street analysts. ETF assets under management rose 20% to $3.1 trillion at the end of September from $2.6 trillion at the same period a year ago. In the third quarter, $34 billion went into equity ETFs, BlackRock's equity ETFs. $8 billion was added to the strategic ETFs, and precision ETFs had $13 billion in inflows. Now, when Larry talks, it's generally a great idea to listen. He was recently on CNBC, and he talked to Jim Cramer and others on Squawk on the Street to discuss the company's quarterly earnings results, the Fed's rate hike campaign, impact of geopolitical tension, inflation, and Treasury yield outlook, and much more. So let's look at this video, and hopefully you'll get some insights overall into the economy and worldwide economics.
I wanted to ask you, on your conference call, say you're disappointed because you're a competitive person. Yep. Sorry about the Dodgers. And what I look at and I say to myself, if you're disappointed with these numbers, you're doing everything you can to bring in money. There's really not more than you can do. And it just happens to be the world and where the bonds are that I think are making it so your competition is tough.
Look, as you said, I mean, revenues were up 5%, operating income was up 7%, net income was up 14%. We did have some outflows in our precision ETFs, which is a great example of more people are choosing iShares to trade around, actively trading it. And when market sentiment turns, like it did in August and September, and people can see that daily, people should pay attention to the precision. You know sentiment, and you see outflows. However, I mean, it's up hundreds of billions of dollars in the last few years. So it's every time we've seen this period of time when we see outflows, we see real inflows when sentiment turns. We had one big client in EMEA who pulled out money. It had nothing to do with it. Our normal flows were 95% of the average flows of the last bunch of quarters. And then systematically over the last 12 months, we're up $300 billion in net inflows. You know, and we see a huge opportunities and flows over the next year or so because of all the things we're working on. And but there is no question we have a better understanding of the texture of what's going on in the market through our ETF platform and our global network. And unquestionably, we're seeing, my barometer of hope and fear. With all the geopolitical issues, we're seeing more fear, more people pulling back. And you're actually seeing that in the yield curve. You're seeing the yield curve flatten.
Right.
And the yield curve is flattening because, people think we're closer to the end of rate hikes. I'm still calling for long rates to be above over 5%. I think the numbers of inflation this week really shows the stickiness of it. We're going to do a lot more military spending as a result of geopolitical issues. We are going to see an acceleration of fragmentation of supply chains because of geopolitical issues, but also as we advance AI and robotics, there is such an enormous opportunity to nearshore, and I think this is all the dynamic. That's part of the dynamics of what's going on in China when you were talking about China and China's growth issues. We are seeing a recalibration. As I think I said a couple of quarters ago, people are reassessing all their dependencies, and one of the great dependencies that the world still has is the amount of manufacturing assembly in China. Right. Technology is allowing us to recalibrate that. And then we're also recalibrating. You look at the growth rates of India, you look at the growth rates of Mexico, great opportunities for long-term investment.
I know you know Mexico very well. Yeah. India was quite impressive this quarter.
And that's where money's going to.
Right.
I was in Japan last week, and the amount of investor interest to invest in Japan is extraordinary. We have a new prime minister in Kishida who has really reoriented the entire economy more business-friendly, business open. They're trying to attract more and more external capital. So we're seeing actually money moving from different locations back into Japan. And Japan has been an area where investors have been systematically underinvested. Right. And so they're now getting back in.
But you make the point of the generational opportunity in bonds, but you just said about the 30-year. Now, I found myself looking at portfolios because I have to invest in bonds, and I was very attracted to, candidly, to the high yield. Right. It just seemed like a great opportunity. But I don't know where you would prefer someone my age. Who's interested in that, and who should be?
As rates go higher, you're going to see more immunization of the old defined benefit plans to lock in. As liability rates went up, we are seeing more and more pension funds, more corporate funds that are actually match assets and liabilities. And so they're going to be able to immunize the volatility. And that means they're going to be selling out of equities, buying more long bonds. And that will happen. It's not happening yet. But let's be clear, if you could start earning 7% on credit, right. If you could start earning 10 to 12% on infrastructure investing as our Infrastructure Act going in, as our IRA starting to be implemented, these are going to be good, healthy, long-term investments that are going to be anywhere from 8 to 15% returns with high probability of success. And so that's where a lot of money is moving.
Okay, it's like, Carl, when I was talking about how the rich people come on and there's like basically it's perilous forgetting. This is what I'm talking about. That's the opportunity. Correct. And people who are listening should say, you know what? In this time of peril, did he just say I might be able to get those rates? That's pretty darn good.
And, right now we're facing a lot of headwinds on geopolitical issues. Hamas invasion of Israel, the horrific acts. That creates a lot of fear, and people are actually pulling back, watching this. At the same time, and the headlines of every newspaper, every website is about the fear issues about the world. But if you overlay the opportunities in investing in AI and robotics, the opportunities in nearshoring and recalibrating supply chain, now, if you overlay, because you were talking about the healthcare companies, now if you overlay the incredible transformation with Ozempic and other items, what it's going to do for longevity of life.
Yes.
Okay, this week we discovered that these drugs can help in renal failure. They can help in other things. Now, if you overlay that and like Eli Lilly's drug for Alzheimer's that extends the pathway by at least 40%. This is creating hope. And so a lot of people ask me, why isn't the market collapsing? Okay, because of all of this. We're not spending time talking about these opportunities of, there is incredible medical discovery that is elongating life. We have great recalibration of supply chains that's going to bring jobs here, opportunities here in the United States, in Mexico and India and other places. So, we're spending so much time on the negatives, but all of this just tells me why you need to continue investing.
Yeah. Well, Carl,
these are the opportunities.
We spend so much time talking about the fact that we're not going to eat sugar and cereal. Maybe we should talk about the idea that maybe our average lifespan is going to be 75.
But, think about what that means, though, getting back to long-duration bonds. So if we're going to be living longer, are we being prepared properly? And if you could start locking in, 7, 8, 9% for 10, 20 years, that's going to give you a lot more confidence and dignity in retirement.
People are betting against themselves. They think they're going to make it to 72. They should be thinking that they can make it to 85. They better have enough money when they get there.
I think that is going to be the biggest societal risk.
Yes.
And I think, look, we're seeing more death because of drug abuse, and so that's bringing down our longevity rates, all those type of issues. Right. And so if you make it to 60, you have a higher probability of making it to 80 and 90 and 100. And so the statistics of the declining mortality rates are hiding some of the real upsides. And I'm not trying to dismiss some of these tragic medical problems like drug abuse but we may be solving obesity, which is a major problem of so many of the problems. And so I'm more optimistic than ever with the overlay that in the short run we're going to have to face some near-term issues.
Right. Do you think that means the median age of the marginal equity buyer rises?
Yes.
Where you'll tolerate risk later in life?
I am, and I'm older. No, there's no question. I think the traditional reallocation, I think the 60-40 type of thing, I think, for a long-term investor, long-term view, who can tolerate market volatility, you should be at least 80% in equities or hard assets.
Amen.
It could be real estate, it could be infrastructure. And if you could really tolerate it, in my mind, you should have been 90%, 100% in equities. Now, a lot of people can't afford that type of volatility.
This is a radical view, and yet it's an empirical view.
It proves out. You got to have a 10, 20-year view. Right. Okay, I'm a hopeful person. I believe that in 10 years and 20 years, humanity is in a better position than it is today. With that view, I want to own hard assets. I want to own equities. I want to be a part of this economy.